Hello, and welcome to the Geopolitics Explained podcast. In the last few weeks, we've been discussing fiscal dominance, specifically for the case of the United States. Inflation remains elevated at 3%, but Donald Trump seems set on cutting interest rates, and this is leading to some worries surrounding debt sustainability and fiscal dominance. The US system is firmly rooted in a cycle between QE and QT. QE ends when inflation or politics becomes the constraint, and QT ends when a lack of liquidity becomes a systemic constraint. But there is one aspect of this that we're yet to discuss, and that is stablecoins. Could stablecoins address either of these constraints? And will they lead to meaningful structural reform, or will they be a temporary reprieve from this QE-QT cycle? Today's episode will explore the Genius Act and how this will change domestic plans in the United States and how this will translate globally. Before diving in further, we'll answer the question, what is a stablecoin? A stablecoin is a type of digital currency that is backed by real-world assets. Importantly, stablecoins maintain a stable price, unless in extreme circumstances where the backing of a stablecoin comes into question. This works similarly to a bank run. A stablecoin can be transferred for an alternative digital or real-world currency, while also being usable as collateral in direct transactions. This endeavour into stablecoins in the US financial system started with the Genius Act. In June 2025, the US Senate voted 68 to 39 to pass the act. This is the first comprehensive federal law that regulates payment via stablecoins. As a part of the Genius Act, there are some rules that stablecoin issuers have to follow. Firstly, they must back stablecoins one-to-one with US dollars or other low-risk liquid assets such as cash or US treasuries. It is also notable that reserve assets can't be reused and interest can't be paid on stablecoins. Transparency is also vital, with larger issuers expected to fall under federal oversight. Smaller issuers could be regulated at the state level in the United States. This expansion of stablecoins is being pursued in an environment where trust is slowly beginning to decline in the US dollar. This debate intensified with the US confiscation of Russian reserves held in dollars at the onset of the Russia-Ukraine war. How would stablecoins affect the US dollar moving forward? Despite the US dollar slowly losing trust, it remains the cleanest dirty shirt today. Every alternative currency in the world is structurally weaker, whether in scale, liquidity, or power. The system of the US dollar as a global reserve currency of today is also supported by deep capital markets, legal enforceability, and military backing. If the US dollar is globalized via stablecoins, then this would strengthen the dollar's dominance. In a nation suffering from hyperinflation, for example, would a citizen of this nation keep their cash in the domestic currency as its purchasing power erodes, or would they choose to hold their wealth in US dollar stablecoins? After all that will be required for a citizen of one of these nations to do this is a mobile phone and an internet connection. 70.1% of the world's population uses a mobile phone, and as of early 2025, 68.7% of the global population had access to the internet. Over 300 million people live in the United States, but the US financial system could be opened up to 5.5 billion people, especially if the financial system of other nations around the world isn't as strong as the US. Since the concept of blockchain was first introduced in 1991, and since Satoshi Nakamoto published the Bitcoin white paper in 2008, the financial system has seemingly been set to eventually head in this direction. There are also how private companies could be involved here. These mega corporations could issue their own stablecoins that were backed by US treasuries. This would lead to more private ownership of US debt and of the US dollar. From here, we have to consider whether this move will be successful, and if so, where this period of transition will take us. Last episode, we discussed how the US system fluctuates between liquidity constraints and inflation or political constraints. QE occurs until inflation emerges or politics brings it to an end. QT then restarts until liquidity in the repo system grows too thin and stress begins to emerge. When this happens, QE begins once again. Today, we've re-entered into a system of QE at a time when inflation remains elevated at 3%. If the macroeconomic conditions were indicating the potential for rising demand and shrinking supply, which they currently aren't, then inflation could rise at the same time as interest rates being cut. This would increase the risk of fiscal dominance. This would erode debt market confidence in the US, yields would rise, and demand for US debt would fall. In the event of a dramatic fall in demand for US debt, the US would have to purchase its own debt. Today, this isn't guaranteed to unfold. In fact, it's likely that it doesn't. But one day in the future, this issue could very much come to fruition. The US's financial system policy is determined by these constraints of liquidity and inflation. When these constraints lead to strain in the system, this is the first point of potential failure that could lead to a crisis. As a result of this cycle, something with the system needs to change. Could stablecoins potentially be the answer here? Firstly, we'll explore the good points of stablecoin implementation. Firstly, stablecoins themselves won't expand the base money supply, since issuers of stablecoins must hold equivalent reserves in real dollars, cash, or treasuries. Stablecoin issuers also can't lend and they can't create credit. As a result, no new base money is created. But stablecoins do relieve the liquidity constraint when QT goes too far. This doesn't come from new liquidity, but from redistributed liquidity. With these stablecoin issuers purchasing short-term treasuries or cash to back stablecoins, this naturally creates more demand for short-term US debt. This ultimately supports the repo system and the collateral available in the repo system. If stablecoins are then acquired from outside of the United States, this person will buy a USD stablecoin, and the stablecoin issuer will have to buy treasuries or cash at a 1-to-1 ratio. This will see funds flow into US dollar assets without passing through US banks, but at the same time, this increase in demand for US treasuries will also boost the availability of repo collateral. Where this does become an issue is if bank deposits within the United States are rotated into stablecoins. But with the US banking system working sufficiently today, and with no interest being provided on stablecoins, there does seem to be little incentive for US citizens to move from bank deposits to stablecoins, especially when FDIC insurance insures bank deposits up to $250,000. As long as the US banking system remains stable and trusted, migration domestically from banks to stablecoins is unlikely. Now we've covered some of the good points, let's dive into the bad. Stablecoins are a horizontal addition to the vertical US financial system. What I mean by this is, in the vertical financial system, the Federal Reserve sits at the top. Banks operate in the economy, taking deposits and providing loans and other services to the public. They operate on the vertical level below the Federal Reserve. The public then sits on the final level of this vertical tier below the banks. Since 2008, liquidity support via the repo markets has been a key aspect of this system. With the Federal Reserve being placed at the top of this system, they act as a last resort in the event of a crisis. This is, of course, simplified, but it paints a picture. The new implementation of stablecoins is a horizontal system. Stablecoin issuers provide stablecoins to people and companies around the world. This raises demand for US treasuries and other assets that are needed to back these stablecoins 1-to-1. If a portion of the US financial system moves from this vertical system surrounding banks, and if it moves to the horizontal stablecoin branch of the financial system, this will reduce the effectiveness of policy tools such as quantitative easing and will hence reduce the US's crisis response capabilities. This would also weaken the Federal Reserve's transmission as a last resort in the event of a crisis, unless a structure is created to provide liquidity to approved stablecoin issuers in the event of a bank run style crisis. To provide a metaphor that describes this, the Federal Reserve remains the last resort, but the pipes that it possesses into the US financial system will reach fewer actors directly under a system where stablecoins are implemented in the US. There are also other issues such as stablecoins themselves not solving spending discipline, long-term debt sustainability, and political pressure on the Federal Reserve. Because of this, stablecoins might help to address the QT liquidity constraint by redistributing liquidity, but they won't remove the inflationary or political constraint that is found when QE goes too far. The key question looking forward is whether stablecoins only delay this cycle between QE and QT, or if this marks the beginning of serious reform that will lead to a new blockchain-based financial system. There is a lot more that we could discuss here on stablecoins, but that's going to have to wait for another day. This will be the last podcast episode of the year. I will be back in the new year. There will be some posts coming out over on Substack over the next few weeks, but the podcast is going to take a short break. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? I've been Dylan, and I'll talk to you next time.